Hi, my name is George Stagnino. I'm the editor of the Peter Dack portfolio. There is a lot of noise around, and as I told you, I spent my time listening to all the podcasts in the evening, and everybody's saying there are wars, there are tariffs, there are geopolitical crisis, World War III, the economy, debt is going to sink the economy, the administration, we don't know what it's doing, all sorts of opinions. So what I thought to do is just show you some very simple indicators that I follow that seems to be giving the right information and listen to the markets. What are the markets saying? This is my framework, the business cycle, the phases of the business cycle. This is when the economy, phase one is when the economy expands. Phase two is when the economy overheats, meaning that inflation, interest rates, commodities, everything goes through the roof. Phase three is beginning of the correction phase when people start buying less because their purchasing power has declined. And of course, business has to cut production and sales because consumers are buying less. Here in phase four is the most dangerous one because depending on how higher has been the rise in interest rates and inflation, the longer phase four is going to last. Why? Because consumers are going to retrench from buying until their purchasing power is reestablished somehow. So phase four is consumers are stop buying until interest rates, inflation decline to levels that they can afford again to buy stuff. Of course, this is bad news for business profits decline and the stock market has enters into a bear market. When the purchasing power is reestablished at the end of phase four, then in phase one, consumers start buying again and the cycle starts all over again. This chart shows our proprietary business cycle indicators. These are market data. These are derived from what the market is doing. And as I wrote in many articles and in my publication, the Peter Dack Portfolio, each rise is an economy expands. Each decline, so the indicator means the economy is slowing down and is consistent with the business cycle. Not only that, but when the business cycle indicators rise, then the cyclical sectors like industrial, financial, semiconductors are the strongest sectors, commodities. When instead the business cycle slows down, like in these periods, then the cyclical sectors underperform, and the strongest sectors are the defensive sectors, staples, utilities, healthcare, and REITs. Now, why do I say that? Because the business cycle, in fact, has started strengthening since the fall of 2022 when the bull market went underway. Beginning 2024, it started slowing down. And it was telling that the market was, stock market and the economy overreached, were too strong, and there started a period of readjustments until this spring in April. Beginning in April, notice how the business cycle indicators started strengthening, meaning that there is more likely what we are witnessing is a phase one kind of environment. This is very important because, in fact, if you look at what I published in the Peter Dack portfolio on page 4, I make an analysis of sectors that are outperforming the market. And since April, the stocks that outperform the market are the cyclical sectors. Constantly, they still do, meaning that investors are investing in growth, in industrials, in financials, in commodities. And in fact, even Bitcoin is going up because of this excess liquidity that is flowing through the market. So this is one indicators, two indicators actually, that are saying the economy is improving, and this is supported by the way the market sectors are behaving. Every month I show this graph to my subscribers, and this is an amazing series of data. It's unbelievable. This shows the growth in producer prices of corrugated boxes. If you want to ship something, you got to put it in a box, and this is what the price of those boxes is. And when they grow, like in this case, means the economy is expanding. But what is amazing about this series, that all these ups and down correspond exactly to the previous series that I showed you about the business cycle indicators that we follow from the market. So what happens in the marketplace is exactly coincides what happens in the real world. This is periods of stronger growth, slower growth, stronger growth, slower growth, stronger growth, slower growth. And now this prices are rising, saying the economy is strong. Producers are shipping and consumers are buying. Okay, what I've been showing so far is that it looks like, quite convincingly, that we are in phase one with the economy expanding and corroborated by the way the market sectors are behaving and how prices are behaving of corrugated boxes. But there is something else that is positive, and is the growth of the money supply, which is the blue line, which is growing at close to 5%. And as you see, the deposits are also, bank deposits are also growing rapidly. Now, why the two are so correlated? Because you need the deposits in the banks. The banks take the deposits, they lend them out, and that's how they create the money supply, the liquidity in the system. So what you see is the money supply growing, and this is good news because there is enough liquidity in the markets and in the economy to support growth. So far, the 5% growth is not inflationary, but clearly notice that the turning point is around the beginning of 2023 is when the bull market started and the economy turned around, following a period of weakness which was caused by a contraction in the growth of the money supply. People got all excited because there is a depression coming, but they forgot to watch that actually the money supply turned around and went up. So not only the economy is strengthening, but there is enough liquidity to support growth. Now, what is important about 5% is that so far the growth of the money supply is not inflationary. If the growth of the money supply goes to 6-7%, then you might see inflation rising. However, this burst of liquidity here is causing prices, as I will show you later, that to bottom out and start rising. As I've been saying in each issue almost of the Peter Dack portfolio, the money supply started growing from here, and it's not coincidental that producer prices, which are very sensitive to the growth in the money supply and liquidity in the system, started turning around, and now they're growing. So the trend of producer prices, the growth of producer prices is up. Even inflation has now flattened out around 2.3%, and now in the last issue has been rising. So what is the point? Yes, the economy is strengthening. Yes, there is enough liquidity to maintain growth. However, I think the good news on inflation are probably over, and we'll be seeing a ratcheting up of inflation as the economy is growing and as liquidity keeps growing at the current pace. However, everything is going to cancel out. If the money supply starts slowing down, then we'll see what happens next. But so far as things are right now, there are two main trends. The economy is improving and inflation has bottomed and is likely to start rising. What about the markets? Well, the markets respond to liquidity. We saw that the money supply is growing, but the fact that there is liquidity is not enough. Is there risk in the marketplace? And this is the bond spreads. The bond spreads are the red line. And as you can see, it has been ratcheting up rapidly. the famous Liberation Day when President Trump announced the tariffs, but then spreads came down, meaning that risk in the financial system has declined sharply. The market responded accordingly. Volatility rose sharply, but now volatility is below 20. So what is the point? The point is, there is no visible risk in the financial market, meaning that yes, there is liquidity with no financial risk, and yes, investors are confident, and this confidence is translated in lower market volatility, which is all too positive trend for the stock market over the long term. What's going to happen in the near term? Well, in the near term, things are a little different from the longer term picture. This is the stock market with this 200-day moving average. The market is above the 200-day moving average, so meaning the momentum is up. However, near-term momentum goes around this blue line and is now below the blue line. As you notice, every time it falls below, we are close to a peak. It fell below here and we are close to a peak. It fell below here and we are close to a peak. So what it's saying is the market is going to pause, and probably is going to pause. October, September is going to not produce great returns. Okay, so what have I been saying? Well, I've been saying that we are in the business cycle at the beginning of phase one. The economy is going to improve. Our business cycle indicators are pointing higher. Prices of corrugated boxes, which are very reliable business cycle indicator, are just being moving higher. The sectors of the stock market that are stronger and outperforming confirm what our business cycle indicators are saying. The cyclical sectors are stronger than the defensive sector. So this is a picture saying, A, the economy is improving, B, the stock market is reflecting this improvement in the economy. However, we have to watch now inflation. Inflation, as I don't think there's going to be major improvement below 2.3% or 2%. If anything, now both prices of producer prices and consumer prices have been slowly ratcheting up, exactly as they follow what the money supply. The money supply bottom in early 2023, and prices of producer prices and consumer prices started moving up exactly that. So they follow closely the money supply. So inflation is going to not show good numbers in the next several months. Now, in terms of stock market, yes, there is plenty of liquidity. The spreads are coming down. Investors feel very comfortable with what they see. Volatility has declined below 20, so that area is positive. However, you cannot shoot a market went too far too fast in the shortest time since April. So our shorter term market momentum indicators are saying this is a time of a pause. And this is where we stand. Thank you very much for following this video. I really appreciate it. I hope you found it useful and be part of your financial planning. I really appreciate it for following me, and I hope to see you really, really soon. So long, and have a wonderful day.